These are the relief that the complainant seeks, and the respective forum, it uh, provides this relief to the complainant. So if the complaint is proved, the forum shall order not to offer hazardous goods for sale anymore, or to withdraw the hazardous goods from being offered for sale by ceasing to manufacture those goods, and to desist from offering services which are hazardous in nature. Then to pay such sum as may be determined by it, if it is of the opinion that loss or injury has been suffered by a large number of consumers who are not identifiable conveniently. Like, for example, in case of food products, there may happen that the food product may be harmful, and or in case of certain drugs, there may be side effects. So such type of products, they would be, the respective forum would direct the company not to offer those goods for sale, and not to produce such goods anymore. To issue corrective advertisements to neutralize the effect of misleading advertisement at the cost of the opposite party responsible for issuing such misleading advertisement. So any type of um, such advertisements that had been issued by a particular company, which may mislead the consumers to buy a product believing that the product is of high quality or has certain features or certain elements. So sometimes companies, they falsely they give misleading, say, quality standards of their products, and sometimes they make comparisons with other products, and they sometimes they try to make the consumers believe that their products, they are much more superior than that of the competitors. So such type of advertisements, where the benefits may have been overstated, they have to be removed. Number one. Number two, corrective advertisements have to be issued at their own cost. And last, to provide for adequate cost to the parties. So in case of any, um, say, inconvenience that had been caused um, to the consumers with the use of that product, particularly relating to services, or any harm has been caused to the consumers by buying and by using a particular product, so adequate compensation has to be provided to the consumers. So the respective forum will direct that company to provide that compensation. So this is all with the with the respect to this particular topic, that is the consumer uh, relating to the grievance handling of by the respective fora, consumer complaints, and the redressal of the grievances. Is there anything in the previous slides or in this slide which is not clear, needs to these were the slides which we took up in the last session the procedure on admission of complaint, and then the appeals and the relief to the complainant, what the complainant seeks from the forum. So anything that you want to discuss? If everything is clear, then we can move to the new topic. So today we'll be starting with the Companies Act. What is a company? Now, the company is an association of many persons who contribute the capital or money to a common stock of that company, and particularly for doing some business and or trade, and the capital that they employ with the company, with that association, naturally different persons or different members, they may contribute different sums to the common stock, and a member who contributes to that common stock, and the proportion of that common stock which is entitled to is the share of that member. So a person can become a member of a particular association of persons who contribute their capital to a common stock, and the proportion to which his capital or he is entitled to is his share. A member can sell his share in the company to some other person, and so he won't remain the member, and someone else would become the member of that particular company. So the shares in a particular company, they are transferable, and but then it depends on what type of company it is. For example, in a public limited company, the shares are freely transferable. But in a private company, the shares are not freely transferable. There are certain restrictions, although sometimes those shares are transferable. For example, on the death of a particular member, the shares may be transferred to the offspring of that particular person. So the legal heirs would get entitled to the share of the deceased person. Now, there are certain features of a company. It is an incorporated association. So, a company is registered under the Companies Act, and there's a requirement that for forming a private company, you need to have at least 2 members, or for a public company, you need to have at least 7 members to form a company. And so 7 members in a public company, they can apply for the registration of the company under the Companies Act with the registrar of the company, and the procedure for registration will take up in detail later on. So a company is an association of many persons. For example, at least two in case of private company, and at least seven in case of public company, and that particular association or that company is registered under the Companies Act. If it's not registered and the number of persons, it exceeds 10 in case of any banking business, or 20 in case of any other business, then it becomes an illegal association. Then artificial person. A company is an artificial person. We humans, we are natural persons, but a company is an artificial person. Why a person? Because like humans, the company is vested with certain rights and also bears obligations. There may be stakeholders of the company. The government is also there. Companies, they have to pay taxes to the government. They have to abide by the rules of the government. So there are obligations as well as rights of the company. So any person, any individual that has certain rights, they are persons, whether they are human beings or or natural persons or artificial persons like a company. Anything which is immaterial, which is not living, does not have any rights. So whether it's furniture, whether it's a motorcycle or a car or anything other thing, they do not have rights. Likewise, non-humans like animals, they also do not have those rights and obligations as humans. So a person, artificial person like a company, has almost all those rights which a natural person has. There are certain types of contracts which an artificial person cannot enter into, like, for example, the contract to marry. So there are differences, but other contracts can be, a company can enter into other types of contracts. So almost they have equal rights and obligations. Then separate legal entity. Like a person is a separate legal entity. Similarly, a company is also a separate legal entity. It has a particular name. It is registered in that particular name. So as we humans, we have a certain name, a particular identity. Likewise, a company also has a particular identity. And it has a separate legal identity, which is separate from the members that form the company. That is the shareholders of the company. The shareholders, they have their own rights and obligations. The company has its own rights and obligations. So the company is a separate legal entity. Then limited liability. Now, the company has, the promoters in the company or the members of the company, they have different types of liabilities. And like, for example, if you take the classification of the companies, company limited by shares or by guarantee or unlimited company, the shareholders, they have a limited liability. For example, in a company which is limited by the shares, the shareholders have a limited liability up to the paid up value of the shares. If the shares are fully paid by the members or by the shareholders, then their liability to the debts that the company owes is zero. Likewise, there's a company which is limited by guarantee. So members, if they have a liability up to the extent of the money which they guarantee, so at the time of the winding up of the company, they would be called upon to contribute to that particular amount which they guarantee. And there's an unlimited company where the members, they have unlimited liability. In case of the winding up of the company or paying the debts of the company, each member can be called to contribute to the full that obligation or relating to the paying of debts by the company. So then we have separate property. The company has a separate property which is distinct, or which is different from the property that's owned by the members of that association or that company. So members may contribute their share or their capital to the company, and they are entitled to receive the profits which are generated according to the proportion in which they contribute their capital. But although they contribute their initial capital for the formation of the common stock of the company or the capital of the company, but they do not have any right to the property that is owned by the company. So, suppose there's a car which is purchased in the name of the company, and suppose there's a managing director who uses that car, and later on, after say retirement as managing director, that managing director cannot take that car to his home. Although he may, if that the car becomes old and it's decided that the company may auction that car, so the managing director or the erstwhile managing director, they can buy that car by bidding for in the auction process. So they can only buy it because it's the property of the company. So the company's property is different from the property of the members that contribute to the common stock of the company. Transferability of shares. Shares are transferable. That means a particular member who contributes to the common stock of the company can sell off his shares in the company to some other person, and that person can become the new member of that company or the new shareholder of the company. And particularly in the public company, shares are freely transferable. But in a private company, there's a restriction on the transfer of shares by the members. But then on the death of a member, the shares would be transferred to in the name of the legal heir of that investor or that member. Then perpetual existence. Once a company is formed, it lives for all times. I mean, unless it is dissolved under the law, under the Companies Act. So on the winding of the company may come to an end. Otherwise, the company may live on for years together. If the members retire, if the members die, still the company will live on. I mean, it, it will still exist. The members may change hands. The shares may be transferred to the offsprings, or the shares may be sold to new members in a company, but the members may cease to exist, but the company will continue to exist. There is a very interesting example given in the book that there was a war, and during the war, a general meeting of the members of the board of directors, who were the members of the company, was held on the premises of the company, and the enemy, it threw a hydrogen bomb at the premises of the company, and all the directors of the company died. But the company still lives on, because the directors may change hands, new directors may come up, new members may come up, but the company would live on. So unless the company is dissolved or it's wound up, the company may live for years. So the company has a perpetual existence. Unlike the human beings or the natural persons, there's no limited life period of a company. Being an artificial person, the company may live on till it's dissolved or wound up. Then common seal. Now, we, the natural persons, we have signatures. When we enter into contracts, we put our signatures on the documents, on the contract papers. A company, since it's a separate legal entity, it enters into different types of contracts, and the official signature of the company is its common seal. Like the contracts which relate to the issuing of shares or debentures, or issuing promissory notes, or lease agreements, or hypothecation, those contracts. So all types of such contractual those documents, they are to be signed, and the common seal of the company serves the purpose of authenticating a particular employee or a particular manager or an official of the company to put that common seal on the contract documents. So through the common seal, the common seal can be used if the company, suppose, has operations in some other country as well. Then a facsimile of that common seal may be used in that particular country, with the name of that country also inscribed on the seal. And under the articles of association of the companies, usually it's given that who has the permission to use that common seal. So the common seal, the company, being an artificial person, can enter into contracts, and naturally the signature of the company is the common seal. Company may sue and be sued in its own name. Like, for example, in case of the previous topic, um, consumer relating to consumer complaints, for example, if a consumer files a complaint with the district forum against a particular company, so it will file the case against the company, not in the name of the directors of the company or the manager or the marketing manager of the company. So companies, the companies may be sued in its own name, and the company may also sue, for example, its stakeholders if they do not comply with their obligations. The company may sue its stakeholders. Then we come to the classification of the companies. A company limited by shares. Now, companies, they issue shares to the members according to the proportion in which they contribute to the common stock of the company or the capital of the company. So a particular shareholder, if if he subscribes and he pays the full amount which is paid on a particular share, then the shareholders' liability would be nil. So in case of any debts which are contracted by the company, or the company has to pay certain debts, the shareholders do have only the limited liability, that's of contributing to the full amount on the shares that the subscribers or the shareholders they hold. So if the shares are fully paid, then the shareholders have zero liability. If the shares are partly paid, then the shareholders they have to pay the remaining amount on the shares. For example, if the shares are, so the paid up capital on the shares is say 100 rupees. So if the shares are just, the shareholders they have paid only 50%, that is 50 rupees on one share, then they have to contribute the remaining 50% on that particular share. So this is a company which is formed, and the members, they have their proportion of the capital that they have entitled to receiving the benefits from the company. For example, the profits which the company distributes as in the form of dividends. So according to that proportion, in which they hold the shares, they are entitled to receive the benefits, that's the dividends from them, or any other benefit which the company gives from time to time. Then company limited by guarantee. Now guarantee, here the directors or the members of the company, they do not subscribe to the shares. Rather, the capital is contributed by other means, and they give a guarantee to the company that in case of any, say, debts which would have to be paid by the company in case of the winding up of the company, or a settlement of debts by the company, they would contribute up to the guaranteed amount. So different members, they would guarantee different amounts. And in case when the company is wound up, the members would then contribute up to the guaranteed amount to pay off the debts of the company. And unlimited company is where the members, they have unlimited obligations to pay the debts of the company. So each member would be called up to pay all the debts that the company may have to pay on winding up of the company. And sometimes this limited, for example, company limited by shares. It may be limited by shares, and the shares may be completely paid off by the shareholders of the company, fully paid up. But then this limited liability of the shareholders may become unlimited liability in case the number of persons or the number of members in a private company is reduced from 2 to just 1, or in case of public company from 7 members to just say 6 members or less than 6 members, and the company operates for more than 6 months with such reduced numbers. So each of the remaining, though the existing, those existing the members would have unlimited company, unlimited say obligation for paying the debts of the company for the period within which the number is reduced from 7 to less than 7. So if with the reduced number the company operates for a period of more than 6 months, then in that case even the members who have limited liability would become liable to pay the debts of the company. Yes, anything related to this slide? No issue?
No, sir.
Okay, so we'll move forward. Lifting of corporate veil. A company has is a separate legal entity. The members who form the company, they are behind that company. The company may sue and be sued in its own name. These are those qualities of the company. But then sometimes it's necessary to lift the corporate veil, particularly when there is a fraud, which the company or what the directors of the company, they undertake that particular fraud, and they use the company for defrauding the stakeholders. So it is necessary for the government to lift the corporate veil, or for the investigative agencies to lift that corporate veil and expose the persons who constitute that company, that is the members of the company. Number one, for the protection of revenue. So if there's a case of tax evasion and purposely the members of the company, they indulge in such type of activities where they do not disclose the company's total profits, or sometimes they circumvent the laws to not to pay the taxes to the government, the company may lift the corporate veil and may direct its agencies to hold the members of the company or the directors of the company responsible, where the company is acting as agent of the shareholders. So sometimes the company is formed by the shareholders as an agent to basically perform such functions which basically, in order to say their nefarious designs, whatever the shareholders may have, or the members of the company or the promoters of the company may have. So they use the company as an agent to serve their those the personal those motives which they have, where the company has been formed for some fraudulent purpose or is a sham. So here also the investigative agencies will expose the real owners or the real members who form the company, and those members will be held responsible. Um, as in the past, we had that case of Nirav Modi. So his wife, his brother, and his uncle, they were all held um, for that particular fraud. So I mean, responsible for that fraud, although they escaped there in India, where a company formed is against public interest or public policy. So if a particular company has its shareholders who are not located within the country, and the members, they belong to some such nation which is at war with that country. So in that case, the stakeholders would not be obliged to fulfill their obligations. So it's necessary to expose those shareholders if they are belong to enemy country, where the device of incorporation is used for some illegal or improper purpose. Again, where the members, they use that device for improper. We have less than 1 minute left, so I'll again take it tomorrow, this slide tomorrow, and we'll discuss in detail. So for some illegal or improper purpose. So if that company has been incorporated with that particular motive, then it's necessary for the investigative agencies to expose the members who had formed that particular company, where the number of members falls within below the statutory minimum, that is 2 in case of private company and less than 7 in case of a public company, then in that case